8.2%, that's your latest full-year forecast on China.
Correct.
Upside, downside risk to that forecast?
I think the risk is rather balanced,
Okay.
Especially after yesterday's trade data. Seems like exports are still holding up okay. And if we don't have another round of virus outbreak, I think our forecast looks reasonable. Of course, you could get export surprise to the upside, or we get another wave of local outbreak. So I think the risk is balanced.
This is really confusing me. New export orders have been pointing down, yet exports have been holding up. Could you explain that discrepancy for us?
Yeah, we got a lot of questions on that divergence. And when we look at the data, I think a couple factors. One is that exports new order, that's more about the volume, how much you're exporting. The customs data in terms of a dollar amount, that's value. So you have both the volume and price driving exports value. When we look at the data, for example, because of all kinds of supply chain disruptions, the prices are increasing in some of the items. So because the higher prices are contributing to stronger exports, that could be contributing to some of the divergence. And also there could be lagging relationship, right? When you ask exporters about order, whereas customs are really measuring how much is moving through the ports, there could be a mismatch in terms of timing.
Okay, just hold the thought. We have some breaking news for our viewers here. On the back of that Moody's cut on Evergrande, it's now Fitch today, just coming out and essentially downgrading Evergrande and its subsidiaries Hengda and Tianji to CC. And the downgrade reflects their view that a default of some kind appears probable. They do believe the credit risk is high given the tight liquidity, declining contracted sales, pressure to address these payments, and limited progress on asset disposals. We'll keep you abreast, of course, of any sort of market reaction. This follows, I should note again, that Moody's downgrade that we got yesterday, also on Evergrande, which was to CA, which is the second to the last before it actually is a default. Hui Shan, let me bring you back in. Why don't we talk about this? Should I be concerned about this deleveraging campaign, let's put it that way, the larger deleveraging campaign, and what it's doing to cooling the housing market to overall growth? Yeah.
I think that's the key risk to watch for a Chinese economy, given how important the housing market is. I think that the fact that exports are still holding up suggests that window of opportunity for policymakers to continue this deleveraging or de-risking mode probably is still open. And I think here, the key for policymakers is really differentiating the credit risk versus the liquidity risk, right? You want to clean up and delever when it's a credit problem, but you don't want to generate a liquidity crunch and jeopardizing otherwise sound financial institutions or developers. So I think that is a risk, and because of the many linkages between housing market to the economy, that's something that definitely need to be watched very closely.
The big if and the upside, back to your first point on mobility and the virus and these lockdowns. You guys, of course, have been following high-frequency data on this. What are these data points telling you? For China specifically, we saw that effective lockdown index measured, to your point, measuring mobility, was quite low before the July-August outbreak, and then it jumped to about 20-25 points in August. And fortunately, we are seeing the effective lockdown index coming down in China with the virus under control. So it is a very good indicator for us to track how virus outbreak translate into restrictions and translate into lower activity. Policy support moving forward, what are you expecting? Fiscal, monetary, triple R cut, LPR, and all this alphabet soup really of tools that they have.
Right. So we characterize it as this is a micro takes, macro gives environment. You're doing a lot of tightening at the micro level. Okay. So for the economy to stay in the reasonable range, the macro policy has to be more supportive. And then when it comes to macro policy, which policy, we think that fiscal policy is more immediate, whereas monetary policy takes time to transmit into the economy. Fiscal policy is more direct, and you can see the impact right away if you really want to lift growth in the fourth quarter. So we think fiscal policy need to play a bigger role. That means local government special bond issuance and on-budget spending. But monetary policy need to facilitate, meaning providing liquidity, meaning making sure credit growth is still solid.